Welcome to our presentation about the current investment environment for Australian investors. This presentation was recorded in September 2013. Before starting, I'm required to show you this disclaimer. This presentation includes general information only, and before doing anything you should seek your own personal advice. And because I like protection, we can never disclaim too much, so I'm also warning you that this presentation includes two eternal truths or axioms that may in fact not be eternal. There are four undeniable realities that may well be disproven. I'm suggesting that there are some investments you should avoid, but they may turn out to be okay. And the good investment ideas could well disappoint. There's also at least one piece of shameless self-promotion. At least one. And all of this in just under 25 minutes. By the way, we do other presentations, my favourite being lies brokers tell their clients, but it takes considerably longer than 25 minutes. And there's a 1-minute presentation that will tell you all you need to know to be successful financially. If we have time at the end, we can go through it. The first of the eternal truths is that human beings make bad investors, so it's dangerous to go it alone. Do-it-yourself investors and lone sailors have one important thing in common: loneliness. Instead of being battered by the wind and the sea, do-it-yourself investors are battered by the inexorable gales of hysterical media reporting, relishing setbacks and forecasting disaster. In fact, in 2002, Daniel Kahneman won the Nobel Prize for Economics for his work in behavioural finance, the study of why human intuition works to the detriment of investors. We value losses more highly than gains, and this can distort objective decision-making. We tend to overreact to positive and negative information, and we attribute any success to our own brilliance rather than to the dumb luck that's usually responsible. We seek to find order in chaos and close the barn door after the horse has escaped, just to make sure it can't get back in again. In short, we make decisions based on emotion, not logic. Humans always seek information to justify what we already believe and ignore information that contradicts us. We get anchored on a price when there's no logical reason to do so. We join in herd behaviour even though we know herding has led to financial disasters in the past. And then, because market commentators tell us why the markets reacted as they did during the day, we believe that someone actually knows. Even worse, if we believe that everything is explainable, then by inference it should have been predictable, and it isn't. My two favourite forecasting errors are speculation and retrospection. Investment professionals are humans too, by the way, and they suffer from the same shortcomings as their clients do. The good ones recognise these shortcomings and have ways to overcome them. So they tend not to speculate, while individuals often do. They hedge their bets and look to profit or contain losses in a number of potential futures rather than just one. They'll never be completely right or completely wrong. Good advisors know that there'll be bad decisions, so they make lots of small decisions, where each one will only have a small impact, rather than making a few large decisions that can turn out badly and cause a financial catastrophe. The error of retrospection occurs when investors assume that recent investment performance provides useful information about what's going to happen next. This chart is based on 100 years of historic returns on the US share market. It compares future returns to past returns and finds the correlation is slightly negative. You're more likely to do well in the next 5 years by investing in what has done poorly over the past 5 years. Sometimes sentiment changes and markets can go from being despondent to being euphoric, but mostly the economic situation changes. Hopefully the next 5 years will be less dramatic than the last 5, but they may not be. While recent history is unlikely to repeat itself, we can learn quite a bit by studying history. So I invite you to join me on a quick tour of the past 60 years on the US share market to see what we can learn. There are many charts like this one in the presentation where the price of shares in red is compared to the underlying earnings in blue. All of the charts are organised so that the lines cross at the median price to earnings ratio, or PE, for the period. So when the red line is above the blue line, prices are historically high, and they're low when the red line is below the blue. By the way, the median PE over the last 60 years on the US share market has been 16.4, and there's a really logical reason why this makes sense when the rate of inflation is less than 3% per year. This is well explained in a brilliant investment book, Kissing the Frog, written by David and Philip Middleton. It was originally published by ABC Books and is now available as an ebook from all reputable ebook outlets. The average growth return from the US share market over 60 years has been 7.2% per year. So if you allow for average dividends, the total return has been around 11% per annum, and the return from the Australian share market has been roughly similar. But the only thing that really matters is the return after allowing for inflation, and this chart shows the same information adjusted for inflation. Over 60 years, the US share market's real growth return has been an average of 3.4% per year, but you can see from the chart there have been several periods of over and underperformance. In the first 20 years, earnings grew steadily with some minor undulations. And share prices correlated quite strongly. Over 20 years, share prices were up by 120% in real terms. The next 20 years were much more volatile, with 3 recessions. The first was in the mid-1970s, resulting from the oil crisis, and the recessions in the early 80s and 90s really resulted from the high level of inflation that ensued. The other thing to notice is how strongly corporate earnings grow coming out of recessions. And investors not only know this is going to happen, they usually plan for it. In this 20 years, there was a major disconnect between share prices and earnings. The high inflation caused interest rates to increase, and investors sought a higher running yield from shares. The only way this can happen is to pay less for them, so the PE ratio fell to less than half of the normal level. In the early 1980s, real share prices bottomed down 62% on what they'd been 15 years before in the late 1960s. Inflation is really bad for share investors. The other thing to note is that share investors usually assume the earnings growth coming out of recessions. But if earnings don't materialise, share prices will fall again, as they did in 1987. Over the next 10 years, earnings grew and then came back a bit, largely due to the period of irrational exuberance during the technology bubble where share prices lost all contact with reality. Here's a question for you. Who coined the phrase irrational exuberance? If you said Alan Greenspan, you were right. And in an effort to stop a recession as a result of the tech market correction, he dropped interest rates to close to zero. This led to a phenomenal earnings growth spurt, and we saw share prices recover, and then collapse again in the global financial crisis. Since early 2009, even though the US economy has remained in recession, the very low interest rates, the flexible and mobile labour situation that exists there, combined with low-price energy from shale oil and a lack of action on climate change, has seen company earnings rebound strongly. The market, caught unawares, has struggled to keep up. So the past 60 years splits into 3 distinct periods: the steady times of the late 50s and 60s, the 20 years of the oil crisis and high inflation where investors saw no real growth at all, and the past 20 years with heightened volatility but strong investment growth. So what have we learned? We've learned that earnings growth drives up share prices over time, but earnings and share prices don't always move in concert. We've learned that low interest rates help earnings to grow. We've learned that recessions cause earnings to fall, but they recover fast coming out of recessions. And we've learned that inflation is bad for business and it's terrible for investors. If you want to learn more about how all this works and why, a good investment book will always help. The first of our undeniable realities is that the emerging economies have emerged and they're becoming a mainstream concern for investors. The green areas are the USA, Europe and other developed economies including Australia. And while these economies have been growing over the past 20 years, the BRIC economies of Brazil, Russia, India and China and the other emerging economies have been growing faster. The annual economic growth has been consistently higher in the emerging economies. These emerging economies were only 38% of the world economy 20 years ago, and now they're 54%, and by 2018 they'll be almost 60% measured in purchasing power parity. For the Chinese, it'll become difficult to be regarded as the most important country on earth while your currency is linked to another. At some point, the renminbi will float and probably appreciate. And at some point, the Shanghai stock market will become one of the largest and most significant markets in the world. By then, it'll be too late to do really well. So how are you going to take a position and benefit from this undeniable reality? The second undeniable reality is that while the global financial crisis has passed, we now have to clean up. So here's another question for you. What do you think is the world's biggest economic problem? I'm sure you can think of many, but in our view, the biggest of them all is sovereign debt. The level of sovereign debt was virtually steady before the global financial crisis, but to avert disaster, the governments of the USA and Europe have taken a huge amount of private debt onto the public balance sheet, and we now have a big problem. For normal people, there's only two ways to reduce debt. You either go into bankruptcy or you pay it back. Governments don't want to do either, so fortunately for them, there's another way. The process is called financial repression, and it's worked before. You just need a bit of inflation to erode the value of debt in real terms. You need to keep bond rates lower than the rate of inflation. And then you need to require people to own bonds and control the flow of capital. This last bit may be a bit difficult these days, although there are plenty of investment mandates that require government bonds, and they are seen as the only option for a low-risk return. Perhaps instead you can have central banks stand in the market and buy bonds to get a similar result. You're printing money to get inflation happening and keeping interest rates down at the same time. At the end of the Second World War, many countries had debt levels compared to GDP that were much higher than they are today, and by using financial repression, the issue was largely dealt with within 10 years. The estimates are that without financial repression, the situation would have only become worse. You may have heard the old joke about the overweight person who tried everything to lose weight short of dieting and exercise. Well, the governments of the world would like to get out of trouble without default, without hyperinflation, without comprehensive austerity, and without increasing taxes. Financial repression is the answer. It worked before. You just get the savers of the world to pay the price in the form of negative real returns, and the best thing is they may not even notice. So what does all this mean for ordinary investors? A period of low interest rates will reprice investment risk. In other words, investors will pay more for other assets in search of an investment return, so we can probably expect an asset pricing bubble. We know this will happen because it happened before with residential property in the USA and Europe as a result of the low interest rates after the tech wreck. And this morphed into the global financial crisis. Expect a new raft of foolproof derivatives pretending to be defensive assets. We're seeing some of these now in the new breed of listed income securities. And in the medium term, the probability of a bout of high inflation is much higher than normal, and this has the potential to disrupt business and also investment markets. Remember, inflation is really bad for share investors. An extraordinarily bad idea would be to invest in government bonds. Investment returns are almost certain to be negative in real terms, and when interest rates rise, a substantial amount of capital can be lost. To learn more about how this can happen, you just need to consult a good investment book. The third undeniable reality is that the construction phase of the resources boom in Australia is over. An enormous supply of raw materials has been created around the world, and now we'll enter the delivery phase. Volumes will be high, but prices are falling, making further investment uneconomic. Potentially prices will fall to the marginal cost of new production, and this is a lot lower than prices are today. Our miracle economy needs to reinvent itself, but it won't be easy. Many parts of the economy have been driven to their knees by the high Australian dollar and high comparative interest rates. And there will be headwinds in the form of potential inflation and our own homegrown fiscal cliffs. The threat of inflation is real, but currently it's not even being discussed. Our currency has fallen in line with the collapse in our terms of trade, and this will be enough to increase the price of almost all the manufactured goods we buy because they come from overseas. If resource prices actually do fall to the marginal cost of production, then our currency will fall by even more, and the inflationary pressure will become enormous. The governments of the USA, Europe and Japan need some inflation for the process of fiscal repression to work. And emerging economies, now over 50% of the world economy, find it difficult to control inflation and enjoy a high level of economic growth at the same time. If Australia had a high level of unemployment, then we may be able to absorb the inflationary hits and our average standard of living would simply fall. But we currently have low unemployment, with the potential of a retirement avalanche not far away that could well put pressure on labour markets. The chart shows the increase in the number of people over 60 each year, and breaks the increase down into how many are working and how many are retired. The change has been dramatic over the past 20 years, with a large number of people now continuing to work. Some of the shift may be due to longer and healthier life expectancy, but especially in the years of 2007 to 2010, many people delayed retirement due to the impact of the global financial crisis on their retirement savings. So now almost 10% of the Australian workforce is over the age of 60, and a third of those are over the age of 65. At some point, most of these people will choose to retire, and this could well add fuel to an inflationary fire well stoked by the inflation being imported from overseas. You might be positive about Australian shares if the market looked cheap, as it certainly was through all of 2011 and most of 2012. Even now, the Australian share market is more than 20% lower than its all-time high. The chart shows the past 10 years for Australia's largest industrial companies. Earnings grew strongly from 2002 to 2007, and prices kept pace for most of that time, but they started to move ahead of earnings growth in 2007. Confidence was high and a price bubble developed, not enough to cause too much concern because earnings were expected to keep on growing. The global financial crisis did very little damage to the Australian economy, but the non-mining economy definitely stagnated. Industrial earnings dropped by 15%, due largely to the large discounted capital raisings during 2009 that diluted earnings per share. Since the low point, average earnings per share have recovered by around 20%, and share prices have come back to fair value. Industrial earnings are expected to continue growing, but prices are certainly not cheap at the moment. The first implication of a struggling Australia was to increase exposure to international investments. For many investors, this is a difficult pill to swallow. For a very long time, international investments provided dreadful investment returns. The major market disruptions like the tech wreck and the GFC were worse overseas than they were here. Our economy was travelling well due to China's demand for our commodities, and this caused the value of our currency to more than double, making it really difficult to make money overseas. And you pay more tax, or you don't get a tax rebate because you don't get franked dividends from international investments. Franked dividends increase the return from Australian shares by 1.5% to 2% per year, but we do need to get this into perspective. In the past 12 months, Australian shares have returned around 25%, including dividends and tax credits, and that's a great performance. But over the same period, the international accumulation index in Australian dollar terms has returned over 35%, so we shouldn't be too tax-driven. To avoid international investments based on past performance is an era of retrospection of gargantuan proportions. Australian companies are not better than overseas companies, and they're certainly not better managed. Our governments and regulators are fine, but they're not better than those overseas. And as a population, we aren't cleverer, more talented, better looking, or even better at sport than people overseas, even people in the UK. We've been lucky, and investors can often ride their luck too far. The second implication is that investors should lock in some inflation protection, and the good news is that at the moment it's almost free. Right now you can buy good quality indexed bonds with a running yield of almost 4% that are revalued quarterly in line with inflation, and the income goes up in line with the value. These long-dated bonds can be bought and sold on the corporate bond market at low cost, although the minimum parcel size is $50,000 and you can't own them through wrap accounts. And then there's infrastructure, and one great advantage of infrastructure assets is that they provide inflation protection that's guaranteed by their monopoly status and by regulation. Toll roads, airports, pipelines and energy transmission investments were disrupted and then reorganised as a result of the global financial crisis. They're still cheap by international standards, offering running yields of around 6%, and with yield growth in line with inflation or better that should drive up the value over time. The third implication of a struggling Australia is to look hard for earnings growth and start by getting out of or avoiding yesterday's winners. The building phase of the minerals boom is over, and the contractors are likely to find the going tough. And the small resources index, after a wild ride, has gone back to where it was 20 years ago. Look for companies with good quality income from overseas like Computershare. Keep an eye on CSL and Ansell, and if you don't own them already, buy some when the price is good. The big low-cost miners get all of their income in US dollars, and they'll be the major beneficiaries of the delivery phase of the mining boom that'll be driven by the emerging economy's growth story. Don't forget that avalanche of retirees, by the way. The major banks now own most of the financial services industry in this country, and their wealth management divisions should do really well, as will the fund managers. The final, undeniable reality is that business models are changing. The tech wreck of over a decade ago was caused by too much enthusiasm too early, but the change is now obvious. The big businesses are overseas, but locally investors will be wise to avoid the potential losers like traditional media and traditional retailers. They have some huge hurdles to overcome. You'd probably even be a little bit cautious about investing in retail shopping centres. We know that shopping centres offer much more than just shopping, but shopping online could well put stress on retail property owners and make it difficult for them to maintain and grow their rental income. And locally there are investment opportunities among the online classified advertisers, firms like Seek, and also retailers that have embraced the new technology. Okay, so we've examined the four promised undeniable realities. We've considered the implications and discussed investments you should avoid and many you should consider. I also promised you 2 axioms, and to date I've only delivered 1. So here's the second. Just as it's impossible for most of us to tell the difference between a good doctor and a bad doctor, a good accountant and a bad accountant, and mechanics and pilots, just by looking at them and listening to them, people can't tell the difference between good advice and bad advice. How would you know? There's even a Nobel Prize-winning investment theory that says it's impossible to do better than the markets, so why even bother trying? And you can't even tell in retrospect because luck will always play a part. But there are some things you can look for. A good advisor will have a narrative, not just investment ideas. Good advisors are process-driven, but they can describe what they're doing and why they're doing it simply and persuasively. They'll provide you with investment diversity because that's the only way they can cover the bases, avoid biases, and provide you with some downside protection to make sure they don't blow you up. And contrary to some opinions, the world is not replete with good advisors or good advice. I also suggested at the start we may have time for our very short presentation we call the 4 simple steps for financial success. And here they are. Firstly, have a financial plan. And by this I don't mean an investment plan. Your financial plan is your overall financial architecture, including your structures and strategies for achieving your financial objectives. Have a plan and review it annually. Secondly, have an investment plan. And the most important consideration, and it'll provide the majority of your investment performance, will be deciding an asset allocation that you can sleep with and that's appropriate to your circumstances. It has to make sense both objectively and subjectively. Thirdly, have sufficient income or fallback resources so you never ever become a forced seller. This will provide all the protection you'll ever really need. And finally, and arguably most importantly, the 4th simple step for financial success is to become a client at Middleton Securities.